Good morning, ladies and gentlemen, and welcome to the last video for 2017. May I wish you a very happy 2018 and also much happiness in your personal life as well as success in your trading. I thought today I would do something a little bit different, and that is look forward in a more macro big picture term at what is going to likely happen in 2018 and the dangers we all face. I don't think it's really that we need to concentrate on the current trends because they are very much firmly in place. Equities are booming, the fixed income market is quiet, the dollar is very slowly giving up its gains, but all those things could change. And what we are as investors and traders, because traders are only sort of faster investors, looking to do is to exploit any quick changes to the forecasts that people have, and those are the things that will produce volatility in the next year. So I have put down here some of my concerns for 2018 in no particular order. That's why I haven't numbered them, I've just bulleted them. I don't know if any of this will happen, but these are the things that I am concerned about the next year. And the consequences of this happening in the markets can be quite pronounced. So without further ado, let's look at the first bullet point. Now, for 2018, forward earnings could disappoint. They always have disappointed for the past X years. The results have not been of that disappointment have not been huge, but at these levels, the results of a disappointment become very significant indeed. So basically we're looking at $135 to $155 per share forward earnings for 2018. Now, even at 17 times, as I've written here, that is a range of 2,300 to 2,635. You have to realize that at some stage we could have a big correction into that box without anything having changed, i.e. nothing has happened, there has been no geopolitical event, nothing at all. It's just that the market lets out some of the hot air and falls down into that range of 2,300 to 2,635. No forecasts have been changed, absolutely nothing. All that has happened is that some multiple expansion, i.e. hot air, has been let out of the markets. If the market were to fall to 15.5 times forward earnings, which it always does, and we'll have a look at a few charts in a moment, that is 2,100 to 2,400. You just have to be very aware that volatility could be a lot higher in 2018 than it has been in 2017, and now we can have a look at some charts that back it up. And this is the first chart, the forward earnings valuations by Yardeni, who is one of the most bullish people out there as far as forward earnings are concerned. He has the market currently trading well over 18 times the forward earnings for 2018. You have to realize that the market could easily fall to his times 17, i.e. do something like it did back in 2015 and just touch the line which is just above 2,400, 2,450. If the market has a deeper correction, which it has tended over the years to go to the 15 times earnings, you can see that a move down to just above this resistance area of 2,200 is absolutely possible without very much having happened or very many people having changed their forecasts. That is a very clear and present danger at all times. I'm just showing you this because it mathematically it's obvious. The more we go up, the more points it takes to make a percent, but also the more points it takes it you know, are down to give up a percent. Therefore, the volatility in percentage terms might not be as big, but in points terms, it is definitely going to be very, very interesting. So that is the first chart, which actually completely backs up the possibility that we have a very wide trading range on the downside, but as well on the upside. Here we have a monthly chart of SPX. As I keep on saying to you, this is a beautiful 5-wave up. We should not be surprised to have an ABC down, which tests some of the moving averages, which are way below the market. It is unprecedented in history to have had the market go up basically the whole year, 12 months in a row with dividends. This is naturally without dividends, and we have two little pauses and two tiny little red bars, but it is unprecedented to have had this kind of move up. This has been a combination of anticipating the tax cuts, the regulations, the fact the market has kept on rotating into sectors. So when financials were strong, something else was weak, and then when financials stopped going up, that something else went up instead. So the indices just kept on grinding higher with absolutely no retracement. It would be no surprise at all to have the market stall and come back and fill and go to some of the lower moving averages, the first one being around the 2465 and the more important ones being just below 2400. Even if nothing changes, that is just a healthy movement in the market, backing and filling and being ready after doing some kind of an ABC between 2750 all the way down to 2300 or so in an ABC pattern before being ready to make a new leg higher. So that is something that tells us that we are more likely than not at some stage next year to have something which backs and fills, and then we are ready for some more movement. On the other hand, and this is now a weekly chart of SPX, if we were to have any kind of geopolitical event like a North Korea bust up or something like that, it would be very unsurprising for the market to very quickly return to the moving averages and test some level like 2490, 2500. That move would be very quick. It would probably only take 1 or 2 weeks. So you have to realize the danger of how many points we could move very quickly in a very short period of time. Being short of puts for pennies is certainly not something that 2018 will look kindly upon, much as it's looked kindly upon in 2017, but I would not try to repeat that same strategy in 2018. Selling puts deep out the money for 1 or 2 points when you could be losing 100 is really not a very clever strategy this year in 2018. What is volatility forecasting? And this is a chart of the VIX, a weekly chart of the VIX. Well, it's compressing. As you can see here, the Bollinger Bands are coming in, the 200-week moving average is still coming down, so it's not telling us that anything is imminent. It would probably trade in a fairly contained range for several weeks. But we do have our triggers. Our triggers are at 1608 in terms of volatility. Any weekly close above 1608 portends some large movement in the futures and SPX, and we know that any kind of close above 1608 is going to foreshadow much higher volatility and much lower prices in SPX. So we have our triggers all set. We are ready to trade 2018. My next danger is theoretical, and that is that the new Fed chair breaks with previous policy, either because he's made to break with previous policy or because he thinks that previous policy was just too slow. We do have a situation whereby the economy is certainly doing very well in the States. It's doing very well globally, in fact, and there could be a decision to accelerate the pace of interest rate increases at the front end, or achieve the reduction in the balance sheet that the Fed wants to achieve faster than the market anticipate they will. The second one is even more unlikely than the first one. In fact, I think this whole one is unlikely, but it's something that we have to be aware of. A new head guy normally tends to bring a change in policy. Just the mere fact that Yellen didn't is not a reason to think that Powell won't. To me, it is more likely that he will at some stage be either forced to or decide to change it for himself, to put a stamp, a personal stamp on the Fed. What could be the catalysts and or consequences? Well, the catalysts could be wild movements in interest rates at the longer end, or a movement in the dollar, which are also my dangers underneath. Here we now get into a theoretical argument about what came first, the chicken or the egg. I don't think it's really worth exploring that. What is worth exploring is the consequences of either of those possibilities happening. And here we have a daily chart of DXY, the dollar index, basically showing that everybody was bullish at the beginning of the year. We went up a little bit, a couple of percent, then everybody started puking it out when they realized that actually Trump wants a lower dollar. The whole, to me, it's politically, it's very, very clear. Trump needs a lower dollar, because to deliver on what he has promised and to get re-elected, he needs manufacturing in the States to become stronger again. And it will only become stronger if it can compete with a lower cost than it currently has, because America has some of the highest costs in the world, both in terms of labor and others, and therefore he needs a lower dollar. Whether he's going to engineer it, or whether he's going to jawbone it, or whether he's going to pressure his Fed chair to deliver it, is a theoretical argument that I don't really want to get into, because I don't care. What I care about are the results. People will say, well, the dollar's really done nothing much. We've been in this range basically for the best part of 4 or 5 months. Yes, we have. But when we look at the next chart, we realize that this is actually a highly, highly unstable position. And this is the same chart as before. It's just on a monthly time frame. And this is why I say it's a very unstable position. This is an equilibrium position. The market has traded over the last 20 years well above it and well below it, but it's an equilibrium position. If now we go out of equilibrium, you can see here that in 1, 2, 3, 4, 5, 6, 7 months we have moved from the mid 70s to over 100, or to where we are now. So if in 7 months we return to below 80, that will be a 15% move in the dollar, which will take the euro, let's call it, in the mid 130s. And actually it's going to be part of Trump's beggar thy neighbor. To me, that would not be surprising. It just would not be surprising to me if, I went away now for the whole of 2018 and came back on December the 31st and somebody told me the dollar was trading at 80. It wouldn't surprise me in the slightest. On the other hand, neither should it surprise if there is something which makes the dollar go very much higher. You can see that equilibrium phases are followed by disequilibrium phases. It is much more likely, in my view, that we trade 80 rather than we go and trade 110 or 120, simply because that is what the desired effect by Trump is. But a move to 80 by the dollar is going to have huge consequences for inflation in the States and therefore long-term interest rates, and it's going to have huge consequences for commodity prices, gold, and everything else. You can see that if that happens, the end results are going to be, on a macro scale, are going to be indeed huge. The commodities argument is one that Gundlach has made in the past few months, and it's actually a very interesting argument, not because I believe that markets always repeat what they have done in the past, but because it's one that actually makes sense. If the dollar has a big move, then commodities will have a big move too. It's just cause and effect. And the charts are certainly looking like it might be happening sooner than we think. All year I have been showing you these charts of commodity indices simply because I felt, even at the beginning of 2017, that they would be significant at some stage, and they are beginning to be more and more relevant. If you recall, the one furthest from the left is the one least susceptible to oil prices, and then we go to the right, the one most susceptible to oil prices, i.e. where oil and energy are the highest components. So if energy is the one going up, this third chart on the right is the one that will be going up the most, and so on. What the problem is? Well, the problem is that eventually these charts on the left catch up with a chart on the right, which makes sense because energy, oil or whatever, is a very large component in the mining of these guys, and therefore sooner or later those price increases are passed on to final customers in terms of higher prices on these charts on the left, which then tend to catch up with the chart on the right. Well, the chart on the right is breaking out. It is breaking out from the level that we marked out many months ago, around 420, and now it's shooting for 450. 458.75 is going to be a very important level. You can see how it caught these lows back in 2010 and how it caught this high back in 2015. It is going to be very hard to break that level. It's going to need quite a bit of backing and filling and time, but you can see what has changed. What has changed in 2017 is that the 200-week moving average and the 50-week moving average, they're all now pointing higher, saying that the risk reward to oil is upwards, and it has been basically since mid 2017 when the market bottomed and has made a nice run. If we go back to the others, you will see that they are nowhere near in such a good position, but that they are beginning to turn. And if they do turn, where do we expect them to go? Well, we expect them to go at least to the 0.382 retracements of the move down that he made since 2011, and that is 112. Well, given that it's now trading at 88, that is a very large percentage move. So you can see how a normal market reaction could be very much amplified and have a huge effect on bonds and the dollar possibly. Well, the dollar could cause it, or it could be it could have a consequence to it. So commodities are definitely looking like they will be far more exciting and volatile than they were in 2017. If we now look at the DBC ETF, which is my favorite commodity tracker ETF, you will see that it has closed the year exactly on the 1671 level that has been the support throughout 2015. I don't think that is an accident. This is what markets do. 1671 to 1794 is going to be an area in which the market is going to have to do a lot of work before it breaks out and goes back up towards the 20s. But that is a humongous move in percentage terms, and it's certainly a move that is going to affect both long-term interest rates and the pace of what Powell does as the new Fed chair. This is a chart of TLT, so 20 to 30 year bonds. It's a daily chart, and basically the market, after the Trump plunge, has regained its poise and has been trading in a very narrow range basically throughout the whole of 2017 in what could be described as an upward channel. The upward channel has been created by the flattening of the yield curve, i.e. the 1 and 2 year sector has been going up the most, while the 30-year has been anchored by the fact there is very little inflation. Trading in basically what has been a 10-point range for the whole of 2017. That, on the other hand, could be very much a flag formation which breaks on the downside. This I can't show you because this is a daily chart, but this trend line goes back all the way back to let's call it 1978. That is the level that if TLT breaks, all hell is let loose. So we are very close. 6 points in TLT is almost nothing. It's like 2 days trading, 3 days trading. Okay, so that to me is the danger, that at some stage we have an accident with the dollar, an accident with Fed policy, and resulting in an accident of in the yield curve where 30 years start going up much more than the 2-year, and we have a re-steepening of the yield curve. That is the danger. Not saying it will happen, just saying the big danger is that. And if it does happen, the consequences are going to be absolutely ginormous, because if TLT now were to break this trend line, and more importantly this trend line later on, we're going to have a massive move, and I'm talking probably at least 1.5% in terms of yield, and that eventually is absolutely bound to hit equities, just like it has every time that the bonds have really spiked. Eventually equities had a minor or major crash. What have I done here? Nothing. I've just changed the scale to a monthly chart of TLT. Would it be surprising to get a move back to these levels around 100 like we were trading in 2014? Why? It certainly wouldn't. So just letting you see that the situation is far more unstable than it looks on the dailies. These levels have been very large resistance, and every time the market could not break higher, it has broken lower. Why would it be surprising to have TLT trade back around 101, 102? That is a very big percentage move. That is a very big move in terms of yield, but it would not be surprising. On the other hand, the accident on the upside could also happen. We could have something which makes TLT go up to 140. Don't quite know what that would be. That would be some kind of massive risk off trade. But as you can see, we are at an equilibrium point, and from equilibrium points, we very quickly get to disequilibrium points. My final point is about the ECB. As we all know, Mario Draghi's tenure is coming towards an end. He is due to retire in 2019, and he has basically timed the end of QE to coincide with his departure. Mario Draghi is an Italian. He naturally cares about Italy first and foremost. He probably has some ambitions, who knows, to become a politician in Italy after his retirement. And all he has done throughout his years at the ECB is basically look after the unsustainable position of the Italian budget. Nobody has benefited from Mario Draghi's policies as much as the big states: Portugal, Italy, Spain, Greece. His QE has actually saved them, and actually they are the ones that will suffer most from any change in policy by the ECB in the future, whether it be just through Mario Draghi's retirement, or what I think is more likely to happen at some stage next year is actual pressure from the northern states, who have full employment, a rising inflation, to actually change his QE policies faster than he currently wishes them to be changed. And that would definitely have some unintended consequences that we can now look at. This is a yield chart of Italian bonds, and don't forget, this is as you probably remember, this is an economy which is running a 130% deficit to GDP. We have moved a whole of 2 or 3 basis points throughout the year. After trying to break the 250 level, the QE was just too much, and we came back to 160, and now we are back towards 2. So overall, over the course of the whole year, we have moved a couple of basis points, and that is not surprising because the QE from the ECB is very much in action, and they keep on buying every setback and removing liquidity, and through regulation making the banks buy more and more of this rubbish. Well, if that were to change through pressure, you won't see the BTP for dust. The big danger for the BTP is that it goes through 260 and probably through 3%. That is the big danger in the BTPs. If we now have a look at the 10-year in Germany, you will see that there again we haven't changed much in terms of yields. We've changed something like 10 basis points throughout the year. This area around 30, or between 25 basis points and 30 basis points, has been a fantastic area of support, which I really don't expect to be broken next year. On the downside, anything that doesn't break on the downside likely breaks on the upside. And that is why I also think that the danger to the dollar is all on the downside. Because if the yields in Europe normalize faster than people have been expecting this year, the danger is that the euro flies much further than people thought possible and goes all the way into the mid 130s very, very quickly. Any move down is going to be supported in the 115, then 112, but nobody's really thinking about the upside. Just as the euro collapsed on the downside from 130 to 110 within weeks, it could also go from 120 to 130 within a month. It's that kind of a currency. This could be the cause of it. We could go back up towards 1% very easily in term. And don't forget that this move, and we are here, right, happened in 1, 2, 3, 4, 5, 6 weeks. In 6 weeks, the market went from where we are to over 1%. Why couldn't that happen again? Absolutely no reason. This could be interpreted as an inverse head and shoulders, and at some stage we break it and we go even higher than 1%. Absolutely, we would not be surprising. What would be surprising is to get another year of very contained volatility in the Bund, basically in a 40 basis point range for the whole year. That, for another year, would be surprising. Let me leave you with just the consequences of any of the above happening. Well, the consequences are pretty obvious. Much higher volatility levels than we have been used to in 2017. Do not get enamored with tight ranges. 2018 is unlikely to be as kind as 2017 was. It might be in the final chapter that in next December we say, well, things haven't moved very much, 5, 6, 7% from where they are here, but I'm sure that in the meantime they will have moved at least twice as much. And therefore our trading style probably needs to adapt, and we need to buy a lot more protection than we ever bought in 2017. Thank you very much indeed for listening to me. I wish you a very, very happy new year, and will be with you as of Monday evening for trading in earnest for 2018. All the best to you and your families.